Hello and welcome to Pro Trader Strategies Market Commentary for Friday, January the 5th. Unenjoyment Friday, as we used to call it on the floor because of the non-farm payrolls. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember, the past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, let's get it on with a plethora of economic data, at least here in the United States and across the pond. We did get some good economic data over there. We're starting to get in some of their flash estimates for the CPI, which is Consumer Price Index. And let's start off with the European CPI flash estimate year over year came in line with expectations at 1.4%. Core CPI flash estimate year over year came in at 0.9%, expected to be 1% actually. So in line with expectations there. Then we got German retail sales coming in a lot better than expected at 2.3%, expected to be 1%. And then they revised last month's number up from negative 1.2% to negative 1%. So that was good there on both fronts there. Then moving over here into the United States, we got our average hourly earnings in line with expectations at 0.3%, albeit they did revise last month's number down just a tenth or tenth of a point. So from 0.2% to 0.1%. So they revised it down slightly. Sorry. Looking at non-farm payrolls. The non-farm unemployment change came in at 140,000. That's 140,000 hires. Expected to be 190,000. So much worse than expected there by almost, 40,000. But they did revise last month's number up from 228,000 to 252,000. So, that helps make up for some of that, but still not nearly as robust as we would have liked to have seen. And if we remember back on ADP was gangbusters yesterday, which that's what I was talking about. You can't really just look at ADP because ADP isn't necessarily in line with the unemployment number. And this is the more widely looked at economic data point is the non-farm payroll, the one that comes out once a month. ADP, they just are not very consistent. So that's why most people look at this non-farm payroll, and this is another reason why. ADP showed that it looked like there was a lot of hires. This particular one showing that there isn't that much hiring going on. So I'm going to go with the non-farm payrolls. Anyway, on to unemployment rate came in at 4.1%, expected to be 4.1%. And then we got the ISM non-manufacturing PMI, which is the Institute of Supply Management, non-manufacturing, which is basically meaning service sector. Purchasing Managers Index came in at 55.9, expected to be 57.8. Anything above 50 is expansion in the economy, but that number was slightly less than expected. Factory orders came in at 1.3%, expected to be 1.1%, and they revised last month's number up from a negative 0.1% to a positive 0.4%. So factory orders better than expected on the revision and on the headline number. That's good. Was a little disconcerting last month when we saw that negative number heading into the holiday season, but now that that's revised, that makes things look a little bit better for sure across the board. And then we also have Mester speaking later on this afternoon at around, right around now. So anyway, on to the overall markets. We've got crude oil coming off just a little bit by about 50 cents, but it's looking a little toppy here. It came up, tested this trend line area to the top where we have this upper band that touched on there, kind of created a little bit of a star doji up there at the top. So that being confirmed to the downside. So just put on that Apache trade, if you guys remember yesterday, looking for a bullish move in the overall crude oil, despite the fact that I'm not really seeing the distilled products get moving. It's kind of like I said yesterday, they're moving from one bucket to another bucket, taking crude oil and turning it into gasoline and distillates. And those inventories are really rising while we're seeing the crude oil inventories go down. And that's because they're refining these products. So it doesn't necessarily mean that there's a lot of demand there now when we're from the way we're seeing the stockpiles build on the gasoline side, RBOB, and everything else. All right, so that could be getting into the market where people are a little bit more bearish. So I wanted to add some downside protection in oil, and I'll show you how I did that in a little bit. All right, gold futures yesterday did settle above the 78 Fibonacci level, totally dashing my hopes of seeing 2112 anytime, or sorry, 1221 anytime soon. I have on a bearish gold trade, albeit it is small, but I am long some puts in GLD, and those are not working out. They're basically worthless at this point, but I'm just going to let it ride out for the next couple of weeks and hopefully get a bit of a correction and try and get out of that there. But today, moving back below that Fibonacci level. So hopefully, for my case, I would like to see it settle below there for sure. And then we've got the new gold, if you will, the Bitcoin futures, or Bitcoin being the new gold, I guess, for the millennials or whatever. We are going to see resistance here as it did top up against this high here on on Wednesday. Actually, it could have been Tuesday late afternoon. So that acting as resistance right now, but just a massive rally today. Well, I mean, what's a massive rally in Bitcoin? Not really 1,600 points, but that seems like a lot to me. Anyway, on to the bonds. Bonds off just a little bit by about a half a point today. I'm going to create a volume node here. I think I would see in the future that the volume nodes here are going to consistently move down as the Fed increases interest rates. Value is going to go down here because as interest rates go up, the value of the bonds goes down. So this is a mechanism of the pricing of those bonds, not the yield. So as yields go up with an increasing interest rate, these should go down. And, I've been talking about that since I've been blue in the face, but I'm, definitely bearish bonds, at least as of right now with good economic data. VIX moving a little bit higher today, up, 13 cents or so. But that being said, we have the equities across the board creating all historical highs. With the Dow Jones Industrial Average up over 80 points right now, creating a new all-time historical high. We are very close to that high right now. As you can see, maybe 20 points off of it. We were up about 100 points earlier today. NASDAQ near the highs of the day, as you can see here, by about 4 ticks, just slightly off of there, but it did just get printed recently, and it is testing this trend channel on the upper band. So that should act as a bit of resistance, in the next few days at least. We might pop above there. It will act as support coming back down if we get above there, but it's going to act as a major resistance, at least in the short term. All right, so with the E-mini S&P is up 9 points as well, creating a new all-time historical high. We can look at this on the daily chart, and you can see that these highs were created intraday here. So that is a pretty robust number. We came up just slightly shy of that here at the 9 o'clock hour my time, which is 11 o'clock on the East Coast. So we are testing that again here in the day session. So pretty strong moves today in the equities. Just not a whole lot of profit taking going on yesterday or today, or for that matter all week. It's just been pretty unabated to the upside as people are allocating monies that they got out of at the end of last year. And that's usually what we see in January. It's called the January effect. It's because you take profits at the end of the year, so you mark your books looking nice. You have a lot of cash on the balance sheet, and then coming into the new year, you allocate those funds again for 2018 in this case. So we're going to see a lot of push to the upside, I believe, at least in January here. USO, this is what I was talking about with that oil trade, with oil kind of popping up and maybe getting a little bit overdone to the upside. I wanted to add a little bit of negative delta and protect some of my position with my Apache APA, which is the ticker symbol there. I used the USO ETF to protect my position and give me a little bit of downside if there is a market pullback. So in USO, I went in there and did the April. So I went pretty far out because I'm buying options. I gained an extra 30 days by going to that April, and it only cost me about 10 cents. I'm going to see a lot less theta contraction, and went in there in the April and bought the 12 puts for 44 cents. So just I did it small as well, just looking to make sure I have a little bit of a hedge in case this is a little overdone and we start seeing a little correction based on that the candlestick setup that we've seen there, where we've gotten a big move to the upside. We've got a doji right there at the top that is a signal for bearishness, bit of a confirmation to the downside here, so we might see a bit of a correction in here. I'm going to have a pretty short leash on this one. We start getting above this 1242 area in the next couple of days. I'm going to pull the ripcord on that one, just get out of it. But this is just in case we see a little bit of a correction in oil, that I have some downside downside risk covered, if you will. All right, that's all I got for you guys today. Today's webinar is going to be on the collar. The collars are really great overall portfolio hedge if you wanted to work it that way, or if you're kind of worried about a particular stock, maybe you're long USO and you want to protect yourself to the downside, something like that. Any stock that has had a massive run, you're kind of worried about it and want to protect it to the downside. I can show you how to set this up. It's going to limit your risk to the upside. We are still bullish with this one, but this is just in case there is a correction in your underlying that you're kind of a little bit concerned about. You can set this up for the earnings as well. I'm going to talk about that. Several different time frames to set this up to increase your probabilities of success with this trade. So check out all my rules in today's webinar. Go to protraderstrategies.com, and if you can't take that, take it easy.